Alright guys, welcome back to Wolfpack Cryptos and MMGinvest. Let's talk about the stock market, and I will go live with the FOMC conference. Just give me a second. Let me post this in the free chat rooms. Links are below the video, so everyone knows that I'm going live again. I just went live, by the way, for cryptos like 5 minutes ago, so check that out. And we'll talk about the stock market and the Federal Reserve's rate hike decision, which they raised another 25 basis points. We're still not even at 3%. But let's take a look at the yield curve, see if that's inverted. An inversion of the yield curve means a recession's like coming, and it's been one of the best indicators for the past few decades. So the yield curve is extremely important, and I'll explain why. But first, let's take a look at the stock market. First of all, this is not financial advice. Consult your financial advisor. I am not your financial advisor. And this is more of an educational channel about economics and trading, how to learn. And do not invest in anything you're not willing to lose or lose sleep over. Always have stops in place or know what you're doing. And this is just my opinion, and I could be wrong. Here's a 1-hour chart of the S&P 500. As you can see, we broke below that major support area. That's why I'm very nervous. And this Fed interest rate decision was extremely important and crucial, because if the market doesn't like what the Fed is doing, there's no support, and the market could easily start crashing. And we're very close to having a 20% retracement from the all-time high on equities. And once you have a 20% retracement, that's like a bear market. That means that we're going into a recession. It's a bear market, and it's already been the second longest bull market in history. So the odds are the top's in, right? The odds are higher that the top's in rather than not. Besides, there's trade wars. There's all kinds of things going on. The Trump trade, the Trump euphoria trade, it went on for over a year and a half. And then there was the midterms, and like I said, they're going to try to impeach Trump. That's negative for the markets. He's kind of his hands are tied behind his back. He can't really deregulate and cut more taxes anymore. Not just that, the trade deficit is actually getting worse. And nobody wins a trade war. That's not helping. I mean, I've talked about that. He's trying to get China to capitulate, but China's not budging, even though China's imploding even worse. But, you know, it's also a global economy. All right, guys? All these multinational corporations, the S&P 500, the 500 top corporations of the United States, these are international companies. And if China starts struggling, and so does Europe, which Europe is struggling, and the emerging markets, the third world, second world, it's eventually going to come to the U.S. because everything's intertwined, because everything is just leveraged up ETFs and derivatives and debt, and it's just a big domino. When you place dominoes in a row after one another, well, once a big enough domino falls, they're all going to start falling, and there's like no stopping it. We also see lending falling. We see mortgages, defaults going up. The home builders are dropping. The VIX has been on a tear lately. Gold actually broke back up to 1250, although it's crashing now. It's sort of a knee-jerk reaction. The dollar, I mean, it's been hanging around the 97 handle, and I've talked about, I'm expecting the dollar actually to break out with that giant cup and handle. And the 10-year yield just fell to 2.8 for the 10-year Treasury notes, the interest rate on 10-year debt that the government owes, right? So, and just recently this week, some news came out that the Federal Reserve, is actually like delinquent, or not delinquent, but they have $66 billion in paper losses. Now that's kind of a complicated subject to explain to you guys, how the Fed can't unload all of the debt that it's taken on since 2009, because they actually went out and bought a bunch of mortgages after the mortgage-backed security bubble popping in 2007, 8, and 9, right? So here's the thing. I will cover the Fed conference. It starts in like a few minutes, but I'm going to talk about things until the conference goes live. All right, guys? Yeah, what's up, guys? There's only 2 of you commenting right now. All right, so the Fed is essentially, with these small rate hikes that they've been doing since right before Trump became president. Well, they started raising rates the very last month of like 2015. So in the beginning of 2016, they started raising rates. And they've only raised it. It's not even like at 3% yet, which is nothing. Normally, interest rates are like, I would say around 6 to 10%, maybe, around that historically. That's what normalized interest rates are. And the interest rates I'm talking about is on everything. Your home mortgage, cars. It's the interest rate that the Fed sets is the interest rate that banks can lend. Essentially everything and the entire economy runs off of debt. It's I mean, the modern day economy is credit driven, and that's the problem. That's why it's a Ponzi scheme. Because if you have economic growth, false economic growth, right? Not based off of productivity, it's just based off of lending money out and people building things that don't really need to be built, or they're getting cheap credit. And a lot of it just goes into the stock market and pumps up these Fortune 500 companies and monopolies as well. But these credit expansions, it happens when they lower the interest rate. So it's easier for banks to lend money when the interest rate's like 0%. It's just easy to approve people for that. And a lot of people end up getting adjustable rate interest loans, and that's the only way the banks will give it to them. So when the interest rates go up, then their loans come due. It's like they give you that credit card and they're like, no interest for a year. And then you're like, oh, sweet, I have to make minimum payments. And then all of a sudden, the interest rate starts spiking, and then your debt really starts compounding. But your wages and the money coming in doesn't increase. So what happens is, when you borrow money and expansion from the future. So you're borrowing money from yourself in the future. And that's how people fall into bankruptcy. Because usually when the Fed raises interest rates, it always triggers a recession. And that's what the business cycle and credit cycle is. It's retarded. And they pull money out of the system. But the funny thing is, if the Fed is raising interest rates and they're pulling cash and money out of the system that they pumped up the system with in the beginning, then how are people going to pay back all the debt when it causes a recession every time and people lose their jobs and they can't pay their debt? The entire thing is, I mean, that's why you have to have sound money, and you have to have something backing it. You can't create Ponzi schemes and expect for it to work every time. I mean, it's pure insanity. But you guys have to understand, this is the only way that they could that governments and banks could survive in the modern day, is creating these Ponzi schemes with credit, with lending money and credit expansion and pumping up the stock market. And what it does in the end is it causes malinvestment. Money shouldn't go into all these businesses because they wouldn't survive in a free market with free, cheap money in the first place. There's the only reason they are surviving is because they're getting free money from the Fed. And the government benefits from this because they get to tax all the corporations. And all the banks as well, right? Benefit from this. And the Federal Reserve is not federal, and they have no reserves. It's privately owned by all the banks, JP Morgan, all of them. And the reserves are nothing. There's just a bunch of ones and zeros and IOUs. That's why the dollar says note. The dollars prior to 1971 used to say this is backed like 40% by gold and silver. And that the biggest expansion in U.S. history was prior to the 70s. And since then, we've just been living off of prior wealth of the United States. And we're just living off of the Federal Reserve's global reserve currency status. And the world is just lending us money and letting us party until one day we can't even pay the interest on all the debt we've accumulated. And that's when the music stops. And I don't know. Like, we're going to take the world down with us. Europe's just in the same boat. So is China. So it's going to be really interesting. So the conference is going to start soon. Let me talk about these markets again. Here's the NASDAQ E-mini futures. And it's below that support line I put right here. And look at this candle on today's candle. Today's candle looks horrendous. It's like a shooting star. It's going to turn into an inverse hammer, but this is like this is a very negative hammer. I forgot what this pattern's even called. All right, so it's starting now. Hold on.
Since the September meeting of the FOMC, however, some cross currents have emerged. I'll explain how my colleagues and I are incorporating those cross currents into our judgments about the outlook and the appropriate course of policy. Since September, the U.S. economy has continued to perform well, roughly in line with our expectations. The economy has been...
Wages have moved up for workers across a wide range of occupations, a welcome development. Inflation has remained low and stable and is ending the year a bit more subdued than most had expected. Although some American families and communities continue to struggle and some longer-term economic problems remain, the strong economy is benefiting many Americans. Despite this robust economic backdrop and our expectation for healthy growth, we have seen developments that may signal some softening relative to what we were expecting a few months ago. Growth in other economies around the world has moderated somewhat over the course of 2018, albeit to still solid levels. At the same time, financial market volatility has increased over the past couple of months, and overall financial conditions have tightened. That is, they have become less supportive of growth. In our view, these developments have not fundamentally altered the outlook. Most FOMC participants have instead modestly lowered their growth and inflation forecasts for next year. The projections of committee participants released today show growth continuing at healthy levels, the unemployment rate falling a bit further next year, and inflation remaining near 2%. The projections also show a modestly lower path for the federal funds rate, which should support the economy and keep us near our goals. As the economy struggled to recover from the financial crisis and the subsequent recession, the committee held our policy rate near zero for 7 years to give the economy the best chance to recover. And the economy did recover, steadily, if slowly at times. 3 years ago, the committee came to the view that the best way to achieve our mandate was to gradually move interest rates back to levels that are more normal in a healthy economy. Today, we raised our target range for the short-term interest rates by another 1/4 percentage point. As I've mentioned, most of my colleagues expect the economy to continue to perform well in the coming year. Many FOMC participants had expected that economic conditions would likely call for about 3 more rate increases in 2019. We have brought that down a bit and now think it is more likely that the economy will grow in a way that will call for 2 interest rate increases over the course of next year. We always emphasize that our policy decisions are not on a preset course and will change if incoming data materially change the outlook. And given recent developments, the statement notes that we will continue to monitor global economic and financial developments and assess their implications for the economic outlook. Now I will provide some additional context and detail, starting with a review of policy over the last year. Last December, the unemployment rate was 4.1% and inflation had been running just below 2%. FOMC participants and many other forecasters were predicting that growth in 2018 would be strong. This growth was predicted to push the unemployment rate down to near historic lows, and the increasingly tight labor market was expected to help push inflation up to 2%. Given this outlook, committee members judged that the appropriate way to sustain the expansion with inflation near 2% was to continue gradually withdrawing the extraordinary support for the economy that had been in place for almost 10 years. Thus, in December 2017, the median of the projections of FOMC participants pointed to 3 quarter-point interest rate increases in 2018, which would have left the target range for the federal funds rate at year-end at 2 to 2.25%, still below most estimates of the longer-run normal rate. Early in 2018, it became clear that the economy was likely to be even stronger than we had expected, in part because the fiscal stimulus adopted near the start of the year was larger and more front-end loaded than most had anticipated. The signs of a more robust economy proved accurate, and the FOMC has now raised rates 4 times this year, counting today's action, 1 more time than anticipated in the median projection a year ago. This illustrates the nature of data dependence that we always emphasize. In 2018, the economy was somewhat more robust than expected, and this led to a slightly faster pace of policy normalization than had been projected. When the economy has instead turned out weaker than expected, the committee has slowed or paused the pace of rate increases, as we did in 2016. And when the economy has performed about as expected, the committee has generally moved in line with the median projection, as we did in 2017. What kind of year will 2019 be? We know that the economy may not be as kind to our forecasts next year as it was this year. History attests that unforeseen events as the year unfolds may buffet the economy and call for more than a slight change from the policy projections released today. With that caveat, there are 2 important differences in the policy outlook today versus next year. In early 2018, we saw a rising trajectory for growth. Today, instead, we see growth moderating ahead. FOMC participants, along with many other forecasters, had long predicted some moderation of growth in 2019. The additional tightening of financial conditions we've seen over the past couple months, along with signs of somewhat weaker growth abroad, have also led us to mark down growth and inflation projections a bit. The median of FOMC participants' projections shows growth of 3% this year and 2.3% in 2019. With growth remaining next year above its longer-run normal value, the unemployment rate is projected to fall a bit further to 3.5% by the end of 2019. Inflation in the median projection remains near 2%. Second, the economy has continued to strengthen this year, and given our 4 rate increases and the ongoing reduction in our portfolio, monetary policy will be providing a smaller boost to the economy in 2019. After today's action, the target range for the federal funds rate is 2.25% to 2.5%, putting it at the lower end of the range of estimates of the longer-run normal rate provided by the committee. Over the next year, if events play out broadly as expected, the federal funds rate will be in a range in which judgments of people both inside and outside the Fed will sometimes differ regarding whether the stance of policy is modestly accommodative, neutral, or modestly restrictive. When rates are in this range, the FOMC makes policy in light of the array of diverse views on the committee. Moving forward, my colleagues and I will be watching the economy closely for indications that the stance of policy is appropriate to sustain the expansion with a strong labor market and inflation near 2%. It's worth noting that the summary of economic projections is a compilation of the individual projections of all FOMC participants. We sometimes point to the median of these projections to illustrate the broad middle of views of the committee. Each participant's projection represents appropriate policy under the baseline outlook provided by that participant. We believe that the SEP provides useful information about committee participants' thinking, but the median is not a consensus judgment and certainly does not represent a committee plan. Actual policy will, as always, be adjusted as incoming data shed light on the state of the economy, the outlook, and the changing balance of risks. Neither the pace nor the ultimate destination of any further rate increases is predetermined. We will adjust monetary policy as best we can to keep the expansion on track, the labor market strong, and inflation near 2%. We know that our policy decisions affect all American families and businesses, and will continue to make our decisions objectively and based solely on the best information and analysis. Thank you, and I'll be happy to take your questions.
Thanks very much. Sam Fleming from the Financial Times. One of the recent surprises has been fairly tepid inflation data. I wondered, first of all, if you could explain why you think, despite the extremely tight labor market, we're still not seeing much in the way of inflationary pressures. In the context of a more data-dependent Fed, how will the Fed respond to further undershoots of inflation moving into next year? Thanks.
Well, you're right, Sam. Inflation has come in just a touch below where we expected it to be, not by a big amount, but by a small amount. More broadly, 2018 has been the strongest year since the financial crisis, and during that period, we've had low unemployment and strong growth, and inflation has still remained just a touch below 2%. So I do think that gives the committee the ability to be patient in moving forward. As I mentioned, there's significant uncertainty about both the path and the ultimate destination of any further rate increases.
Hi, Heather Long from the Washington Post. Today, the Fed lowered its expectations for interest rate increases. Given that, I'm wondering if the Fed has had any discussion of altering the course of balance sheet normalization, and if you could give us any insight on what might lead the FOMC to alter that balance sheet normalization in 2019.
Sure. If you go back some years, I think people who were working at the Fed in 2013 and 14 took away the lesson that the markets could be very sensitive to news about the size of the balance sheet, the pace of asset purchases, the pace of runoff, and things like that. So we thought carefully about this, on how to normalize policy, and came to the view that we would effectively have the balance sheet run off on automatic pilot and use monetary policy, rate policy, to adjust to incoming data. And I think that has been a good decision. I think that the runoff of the balance sheet has been smooth and has served its purpose. And I don't see us changing that. And I do think that we will continue to use monetary policy, which is to say rate policy, as the active tool of monetary policy.
Thanks. Nick Tamaros at the Wall Street Journal. Chairman Powell, you talked a little bit earlier about the ability to be patient. And so as you think about your next policy moves, are you inclined to go at the current recent pace to a slightly different destination that's laid out in the projections today? Or does the current environment of restrained inflation maybe allow you to space out your next few moves and take more time to get there?
So as background, I would just point to 2018 being a very strong year and the committee looking forward to 2019 and still having what amounts to a positive forecast. We still are forecasting individually growth a bit above its longer run potential, 2.3% is what we're forecasting. We're forecasting that growth will be strong enough that unemployment will drop still further and inflation will remain right near our target. So I'd say that's a reasonably positive forecast. Going forward, you know, I will be looking in particular to see whether incoming data tell us that we're in fact on that path, that the development of the economy is in line with that expectation. That will be the main thing. More broadly, though, I think we've reached the bottom end of the range of committee estimates of what might be neutral. I think from this point forward, we're going to be letting the data speak to us and inform the outlook and inform our understanding of what would be appropriate policy. So there's a fairly high degree of uncertainty about both the path and the ultimate destination of any further increases.
Stephen and Binyat.
Mr. Chairman, Steve Leisman, CNBC. Could you tell us how three things affected the outlook for the economy and rates? The first is how the market's decline affected the outlook for the economy and for rates. The second is trade tensions and the tariff war, how you factored that into your outlook. And the third is comments by the president urging you not to hike rates.
So as I mentioned, we monitor a broad range of economic conditions, and including financial conditions, a broad range of financial conditions. And we took on board the tightening in financial conditions, which not any one condition, but broadly speaking, financial conditions have tightened since the September meeting, really. So we took that on board in our forecast. That's why the forecast for growth and inflation went down a little bit. But remember, that's in a context of a more accommodative path. So we also took down our rate forecast. So we definitely did take that into account. And as you can see from the statement language, we acknowledged those risks in the clause about monitoring developments. And we're going to be watching carefully to see as those things develop. I think more broadly, there's been a sense of concern among business people and market people about global growth. And that may be partly about trade tensions. It may be partly about a variety of things. If you just mechanically drop into a model of the U.S. economy tariffs, you don't see very large effects. The large effects would have to come from financial market changes or from losses in business confidence, and those are things that are very difficult to model. On your third factor, political considerations play no role whatsoever in our discussions or decisions about monetary policy. We're always going to be focused on the mission that Congress has given us. We have the tools to carry it about. We have the independence, which we think is essential to be able to do our jobs in a non-political way. And we at the Fed are absolutely committed to that mission, and nothing will deter us from doing what we think is the right thing to do.
Kenya Applebaum, The New York Times. You're about to undershoot your inflation target for the 7th straight year. Your new forecasts say that you're going to undershoot it for the 8th straight year. Should we interpret the dot plot as suggesting that some members of your committee believe that policy should be in a restrictive range by the end of next year? And if so, can you help us to understand why people would be advocating restrictive monetary policy at a time of persistent inflation undershoots?
Well, we, as a committee, we do not desire inflation undershoots. And you're right that inflation has continued to surprise to the downside, not by a lot though. I think we're very close to 2%, and you know, we do believe it's a symmetric goal for us. Inflation is symmetric around 2%, and that's how we're going to look at it. We're not trying to be under 2%. We're trying to be symmetrically around 2%. And I don't, you know, I've never said that I feel like we've achieved that goal yet. The only way to achieve inflation symmetrically around 2% is to have inflation symmetrically around 2%. And we've been close to that, but we haven't gotten there yet, and we have not declared victory on that. So that remains to be accomplished.
Gina? Hi, Gina Smilek, Bloomberg News. Just following up on Binya's question. I guess if you haven't achieved 2% inflation and you don't see an overshoot, which would be sort of implied by a symmetrical target, what's the point in raising rates again at all?
So again, I'd go back to the health of the economy. If you look at 2018, as I mentioned, this is the best year since the financial crisis. You've had growth well above trend. You've got unemployment dropping. You've got inflation moving up to 2%. And we also have a positive forecast, as I mentioned. And in that context, we think this move was appropriate for what is a very healthy economy. Policy at this point does not need to be accommodative. It can move to neutral. It seems appropriate that it be neutral. We're now at the bottom end of range of estimates of neutral, so that's the basis upon which we made the decision. I also think we took on board, you know, the risks to that, and you know, we're certainly cognizant of them.
Marty, and then Mike.
Mr. Chairman, Marty Kretzinger with the AP. You've established for this coming year a communications panel to look at how the Fed communicates. Could you talk a little bit about what you expect to get from that panel? And will the dot plot be involved in that at all? How do you think the dot plot is working? Are we dealing with it the way that you want us to be handling the dot plot, or is it something that you might tweak a bit?
So this review, what it really is, it's coming at a time when the economy is strong, and it's a good time to take a step back, we think, and ask whether our strategy and our tools and our communications around monetary policy are doing the job that Congress has assigned us to do on behalf of the American people. And what we're going to do is we're going to open ourselves up and have a discussion with many outside groups of all different parts of the economy, including an academic conference in June in Chicago. And again, the idea is to listen to new ideas, better ideas, old ideas. Many of them have been around, and try to assess whether there are better ways we can do things. One of the overarching facts is that rates have been really coming down overall for more than 3 decades now. We may be in a world where interest rates are just lower for the time being, and therefore we'll have less policy space to react to economic downturns. And we'd want to be evaluating ideas for, again, for better achieving the goals that Congress has given us. We're not looking at law changes at all, and we're not looking at changing the inflation target, for example. We are looking for better ways to achieve the inflation goal, for example, on a symmetric basis. So that's the sense of that. So as I mentioned on the dot plot, you asked about the dot plot. I think the dot plot generally does provide useful information about the reaction function of committee participants, sometimes more useful than others, I'll admit. But in general, I think people sort of have it figured out and understand what it is and what it isn't, but that doesn't mean we don't like to repeat what it isn't, which it's not a consensus forecast. It's not something that we vote on. It's something that each of us writes down, and we always update it as data come in and as we update our outlooks.
Mike, and then Edward.
Michael McKee from Bloomberg Radio and Television. The balance sheet reduction, how much additional tightening do you think has come from that? We note in the markets that the cost of credit rising, commercial paper, repo rates, the TED spread widening. Do you see any concerns about the availability or the price of credit that could slow the markets? And if in 2019 we see the economy start to slow, would you, if you don't adjust the balance sheet, be risking too much tightening?
So we do watch all of that, but the amount of runoff that we've had so far is pretty small. And if you just run the quantitative easing models in reverse, you would get a pretty small adjustment in economic growth and real outcomes. So we don't think, things that are happening at the short run, at the short end, are driven by many other factors other than the balance sheet runoff. For example, just very large bill supply has pushed up short-term rates, has pushed up repo rates. Tightening of the federal funds rate has raised short-term borrowing costs. So, we're alert to these issues. We're watching them carefully, but we don't see, the balance sheet runoff as creating significant problems.
Evan Lawrence, Fox Business Network. Thank you, Mr. Chairman. We've seen enormous volatility in the markets recently. We know the president said, don't raise interest rates. That's well documented. The National Association of Realtors chief economist says that it's starting to affect first-time home buyers with the mortgage rates going up. When do you think these pauses need to come in next year? Do we need to keep this, as you say, gradual? And then, in addition, what data are you specifically looking at for you that shows when the Federal Reserve starts to become that headwind in the economy with the rates?
We're watching. We have a strong forecast generally for next year. That forecast involves growth at between 2 and 2.5%. It involves growth at a strong enough level to continue driving unemployment down and inflation near 2%. So that's a pretty positive forecast. So to make further moves, I'll be looking for data that suggests that that's in fact the path that we're on. As I mentioned, once you're broadly speaking in the range of neutral, I think it's appropriate to be putting aside individual estimates of that and be looking at what the incoming data are telling you about the outlook, updating your estimates of what neutral might be, of what the natural rate of unemployment might be, of the state of the economy. So, and letting that lead you to adjust your outlook and therefore your appropriate path for policy. So that's what we mean when we say we're data dependent. Of course, we're always data dependent, but I think it has a particular meaning in this context, which is that.
Hi, Mr. Chairman. I wanted to ask, first of all, whether you're worried that President Trump's tweeting and statements might interfere with your ability to communicate with markets and why you're doing what you're doing. And then also I was wondering if you could comment on Governor Brainerd gave a speech recently where she laid out the case for the countercyclical capital buffer being activated. Do you disagree with her analysis? Is that something that you think the Fed should look at doing?
I'm not worried on the first question, because I know, and everyone who works at the Fed knows, that we're going to do our jobs the way we've always done them, and that involves, getting the best thinking together, diverse perspectives. Every business cycle, every FOMC cycle, we talk to hundreds of people in all different parts of society, not just business people or market people, but people from community development organizations. We get survey data from thousands of people, and so we really do have a pretty broad exposure to what's going on in all different parts of the country. And we're going to take all of that information in, and we're going to make the best decisions we can, and nothing will cause us to deviate from that. In terms of the CCYB, so the CCYB is the countercyclical capital buffer is a tool that allows us to build capital at a time when vulnerabilities, financial stability vulnerabilities, are meaningfully above normal. And so that's a tool I'd be absolutely willing to use and happy to use at such time as that test is met. We meet and discuss that and evaluate it on roughly an annual basis. We haven't done it since early this year. I think we'll be doing it early next year, and we'll be reaching that judgment. Then I will tell you, I recently gave a speech saying that I believe that financial stability vulnerabilities were roughly at a moderate level. So for me, but I would want to leave my mind open on that and have that discussion with my board colleagues when the issue arises.
Ann Safir with Reuters. You said that policy does not need at this point to be accommodative, but does it need to be restrictive, as the dots seem to suggest that it will be?
Well, it doesn't currently need to be restrictive, no, and I don't believe that it is. I don't believe that policy is restrictive.
Next year, the dots suggests it will be restrictive next year. Should it be?
Yeah, I've discussed this a couple of times. It's a very good question. And I guess I would just go back to this. The individual forecasts are not something that the committee votes on. They're out in the future. We vote on the rate increase and we write down our own personal paths. So people have disparate views on what the endpoint could be. Ultimately, it's going to depend on what the circumstances are. There would be circumstances in which it would be appropriate to go past neutral, and there would be circumstances in which it would be wholly inappropriate to do so. So I wouldn't put too much on. It does inform you the way people are thinking about things, but I wouldn't take it as a signal about current policy or about near-term policy.
Hi, Paul Kiernan from Dow Jones Newswires. Thanks for the question. In Dallas last month, you talked about the usefulness of speaking with businesses to sometimes hearing things that aren't yet showing up in the economic data. And I was just wondering if you're hearing anything from businesses that might explain the recent market moves. Are markets onto something that, again, hasn't showed up yet in the data? Thanks.
So if you look at the Teal book, or we get the Teal book in person from the Reserve Bank presidents who come in and they share their discussions, not just with their directors, but with literally hundreds of business and nonprofit, and labor union people around the country. And I personally find it really interesting. I mean, my background is very much working, starting with a small group of people, maybe a company, and working out. So that kind of anecdotal data really helps me capture the picture better. So, and what you're picking up now, I think, is there's a mood of concern, or it's a mood of angst about growth going forward, if I could just capture it in one thought. There are many reasons that are given for that, but generally speaking, it's a concern about, is growth going to be as strong as it was? Why not? What might it be? Different people, but that mood is out there. That doesn't mean that it'll come into the real data in a big way. It may, but or that financial conditions will tighten further. We'll just have to see. For now, financial conditions have tightened a little bit. We've taken that on board, both in the outcomes in our forecast, but also in a lower rate path to provide some accommodation to push back against that tightening. That's how I think about it.
Okay, Greg, and then Nancy.
Greg Robb from MarketWatch. Just following up on Paul's question, President Trump said recently that you should feel the markets. So when you see the markets, what are the markets telling you?
Financial conditions, broadly speaking, we don't look at any one market. We look at a really big range of financial conditions. And what matters for the broader economy is material changes in a broad range of financial conditions that are sustained for a period of time. A little bit of volatility, speaking in the abstract, some volatility doesn't probably leave a mark on the economy. So we look for that. And what we've seen here is a tightening. There's been a tightening since right around after a week or so after the September meeting, and that we tried to factor that into our models of the economy and to the results that come out of those models. That's how we think about it. So we do, we follow markets really carefully, but remember, from a macroeconomic standpoint, no one market is the single dominant indicator, and it really matters if changes are sustained over time.
Nancy, and then Donna.
Nancy Marshall-Genzer with Marketplace. Do you still think core PCE is a good measure of whether the economy is overheating? What do you think of other measures like setting a target for economic growth and relying more on that?
Well, I think we look at both, but core PCE is a good indicator. It has what's happened over really 50 years is that inflation has become much less reactive to changes in growth. There was a time when inflation reacted really quickly to changes in growth and changes in unemployment, and that time is behind us, and that is often attributed to the success of central banks in anchoring inflation expectations so that people believe that inflation will come back to the target or around the target, so it doesn't go down as much. Inflation doesn't go down as much in a downturn. Doesn't go up as much when the when the economy is strong. It's really true though that inflation has not reacted a lot on a road from 10% unemployment to now 3.7% unemployment. Now it did move up last year, but in terms of just targeting growth, I actually think our dual mandate works very well, which is maximum employment and stable prices. Most of the time, those two things work together. When they work temporarily in different ways, we take a balanced approach. But I think that approach has served us well, and I think we can work well with it.
Chairman Powell, Donna Borak with CNN. Next year, every meeting will be a live meeting, so presumably there will be some adjustment in how the market anticipates when a rate hike is coming. How has the committee thought through communicating those potential policy moves, especially in light of the fact of the tremendous amount of uncertainty going into next year?
I think having regular press conferences will be a big gain for communication. I certainly hope it will. That's the plan. And so being able to come out after each meeting and explain the committee's thinking and relate that to the state of the economy and expectations for policy and global developments, I think it'll be, the idea is that it'll be helpful in explaining how we're thinking and, explaining what we're thinking about policy going forward. So that's the plan. I do believe it will be a positive development. I think it'll also become the case over time that there will be no prior as to whether we would move at a quarterly meeting or one of the meetings at which we do not file an SEP. As you know, we only update our projections under the current approach quarterly, whereas we have eight meetings. So I think we'll move to a more we'll have the ability to move at 8 different meetings, not 8 times, but at 8 different meetings on the year.
I guess that's sort of the question that I'm trying to drive at is in terms of communicating to the market, because the market's been so adjusted to the fact that these are quarter-end rate hikes, and now you have the potential to move 8 times a year. Is the Fed thinking through how it's going to communicate when it plans, especially given the amount of uncertainty?
Yes, I think that's probably pretty straightforward. If we want to communicate something about something that's going to happen at a future meeting, I think we know how to do that in speeches, in press conferences, and such.
Okay, Don Lee with the LA Times. You mentioned broad-based wage gains this year, and wondering if you see further acceleration in wage growth and just how much slack there is in the labor market.
So what we've seen is a very gradual and I think ongoing increase in wages. If you go back a few years, you'll see that we look at many indicators of wages and compensation, but there are 4 principal ones, and they were all kind of clustered around 2 if you go back 5 years ago, 2% increase per year. Now they're all at 3, and they've just continued to gradually move up, not perfectly in sync, and that's a number that is, right in keeping with 2% inflation and 1% productivity growth. So in an economic sense, it makes sense. I do expect, and I think many forecasters expect, that wage increases will continue, and that would be a welcome development. Wage increases do not need to be inflationary. There's plenty of evidence of situations, for example, in the very tight labor market of the late 1990s, as I think I mentioned in a speech a month or so ago. We had wage increases above productivity plus inflation, and we didn't have high inflation. So it would be welcome. We hear a great deal of anecdotal information about labor shortages, along with other, bottlenecks and things. But so I would expect that wages will keep moving up, and it doesn't necessarily mean inflation. We don't think of it that way. So, did I answer your question? Labor psych. Yeah. So, by most indicators, we look at a very wide range of indicators on the labor market. And by most indicators, we are at or even above longer run normal levels. But I would point to one particular pocket, and that is labor force participation by younger prime age workers, particularly prime age males, is still meaningfully below its pre-crisis level. Most other age groups in both genders have moved back up pretty close to where they were at the last cyclical peak. There's a question: can we go above that cyclical peak? And or are the problems more structural than cyclical, and that there isn't? So we'll have to find that out. I think, given a strong economy, we've had the luxury of finding out that labor force participation can be higher than we had thought, and that's nothing but a good thing.
Hi, John Helpman with American Banker. A regulatory question, if I may. So many of the Fed's regulatory proposals so far, especially this year, have been primarily focused on banks in the sort of medium to small range. That is, sort of tailoring enhanced prudential standards, particularly for those banks. And I'm thinking of the stress capital buffer, as well as the most recent proposal on banks between 100 and 250 billion. GSIBs and the largest banks seem to be sort of left out of a lot of these proposals, and I'm wondering if that is meant to send a message that the Fed does not really intend to change its regulatory structure for the largest banks going forward, or if you'll get to that maybe later. And I'm thinking specifically of the GSIB capital surcharge, which several members of Congress have sent letters to you asking you to revisit and reconsider.
So you're right that a big focus of what we have been doing has been tailoring regulations. And the sense of tailoring is that we want to look below the level of the GSIBs at the large regionals and then on down to the community banks at various steps and ask whether we have appropriately tailored regulation and supervision to account for the fact that smaller and less complex organizations present a much less significant threat to the economy and to the community should they fail, should they experience material difficulty. So in the nature of that, you're focused more on the smaller institutions. I think with the larger institutions, we want regulation and supervision to be effective and efficient. I know that the larger institutions tend to be the ones who care about the Volcker rule. That's something we're working on. We think things need to be looked at carefully, and I wouldn't want to materially change capital levels because I think it's important that the largest financial institutions, the largest and most complex, the systemically important ones, be held to the highest standards and higher expectations. And while we may tailor some regulations, those fundamentally high expectations are not going to change.
Okay, Steve, and then Courtney.
Steve Beckner, freelance financial journalist, reporting for NPR, Chairman Powell. I know you look at many different financial indicators, but let me focus your attention briefly on bond yields. The 10-year note yield has gone down pretty steeply, roughly 50 basis points, I think, in recent weeks. Wonder what you make of it. Is it a worrisome sign for you in terms of the outlook for growth, for inflation? On the other hand, could it be a positive in terms of presumably bringing down mortgage rates and helping the housing sector?
Again, we do focus on a broad range of financial indicators, and we don't obsess about any particular one. We look at a whole range of them, and we ask ourselves what's really going on in the broad picture out there. If you ask what's going on with the longer maturity Treasury market has come in some. That's consistent with a risk-off feeling in the stock market as well. And we don't know whether that'll persist. Really, the longer Treasury has moved in a range above 3% and down 3% as the risk sentiment has changed. I think if rates were to stay low for a longer period of time, that could be thought of as a signal of expectations of lower growth, but we don't know that that'll happen. As I mentioned, our forecast for next year is, I think in keeping with most other forecasts, is that we'll still have solid growth next year, declining unemployment, and a healthy economy.
Hi, Chairman. Courtney Brown from Axios. I'm wondering if you can clear up what's become a little bit of a debate in the financial community. You said in October in an interview with PBS that interest rates were a long way from neutral. A month later, you said interest rates were just below neutral. And I think a lot of people interpreted that as a shift in tone from you. Were they right to interpret it that way?
You know, monetary policy is a forward-looking exercise, and I'm just going to stick with that. It's where we are right now is we're at the lower end of the range of neutral. We've arrived effectively at the bottom end of that range, and you know, there are implications of that. For that, as I mentioned, going forward, there's real uncertainty about the pace, and the destination for further rate increases, and we're going to be letting incoming data inform our thinking about the appropriate path.
Okay, Michelle with the last question.
Michelle Fleury, BBC News. Chairman Powell, you talked about monitoring global developments. I was wondering, you touched on the trade dispute with China, but could you elaborate on what economic developments you're referring to, whether Brexit is one of those, what else?
More broadly, I'm referring to global growth. So if you go back a year, 2017 was a year of kind of ongoing upside surprises in global growth. It was a year of synchronized global growth, and people raised their forecasts for growth around the world kind of throughout 2017, and in some sense expected that to continue into 2018. What has happened instead has been a modest retracing of that. So you have still healthy levels of growth in the aggregate around the world, but close to the potential growth rate of the global economy. But you no longer have the really strong levels of growth you had in 2017. So that is one, that's I think the key fact. We also monitor, event risks like Brexit, like the negotiations between Italy and the EU over their budget. And as far as those are concerned, we monitor them very carefully. And I'll mention Brexit. Our financial institutions have had a long time now to get ready for the full range of possible exits from the EU by the UK. And they've had supervisory involvement from US supervisors, from UK supervisors, from EU supervisors. We think they are fully prepared for the full range of outcomes that may come out of that. I was very happy to see the developments around central counterparties today. That was a big issue that seems to have been satisfactorily, for the time being, resolved. So it's something we're watching carefully. Honestly, it shouldn't have major implications for the United States, but there's a lot of uncertainty because it's not something that's happened before. So we'll be watching it carefully.
All right,
Thanks very
guys,
much.
can you hear me? Can you guys hear me? There's such a lag with the comment section. Alright, well, that was that was interesting. I've actually never seen the market drop like that before, and I've been doing this for a while. Like, I've never seen the market drop. I mean, it is volatile during Fed announcements, but I've never seen it actually drop this much, this fast. And the technicals, I mean, this looks bad. The technicals, just looking at the chart patterns, it's screwed. I mean, we're in a recession, like, right now. According to the stock market. Just looking at this. So, I mean, my short was hit on the E-mini. So I'll make money on the way down. Metals, yeah, metals were also hit. And that happened in 2008 when the market started crashing. Gold and silver also crashed with the markets because everyone sells everything and just piles into dollars, into cash, when the market drops. I mean, this is bad. We're screwed. It's hilarious. You can see that he has no confidence as he was talking. And he expects to have 2 more rate hikes. Not after he got off that stage. He probably looked right at his phone, or someone just went up to him. He's like, the stock market just fell like 300 points. And he's like, oh shit. So what are they? They're probably going to come out with some sort of article, like news release tomorrow. And or who knows, maybe they'll just do like an emergency conference. And Trump's going to blame this on the Fed. And technically he's right. I mean, the Fed just popped its own bubble. Look at this. New all-time lows for this year. And it's not stopping the fall. This is the very last support right here. And then we're just going to fall straight to like 2,200. And at that point, it's like a 30% drop. Something like that. Like a 30% drop in the stock market. Which, that signals, that's it. It's done. It's over. Recession, bear market. And, I mean, the technicals, this looks really bad. Look how fast it's dropping. Let's go to a 10-minute real quick. See how fast this is dropping. Get out of here. Yeah, I mean, in the past hour, the market fell from 2,400. This is the Dow Jones, or 24,000, to 23,000. That's 1,000. It's almost 1,000-point drop. This is bad. This is panic. Cryptos are dropping right now as well. Let's take a look at the FANG stocks. This is a daily. This is engulfed doji. I mean, this looks bad. Who's gonna buy this knife? Like, who's gonna put in the bottom? Look at this. This is oil. Oil's dropped to 47 a barrel on light crude. And oil does that right before the like a stock market correction or crash. It crashes right before, well, with it technically, I guess. Here's some financials. S&P 500 financials. It broke below support. Dow Jones financials really below support. I mean, this is a straight up crash. Look at this. Well, I called it. So the market closes in about 40 minutes. And a lot could happen in 40 minutes, guys. A lot can happen. I mean, we see another 10%, 15% drop in 40 minutes. And then who knows what's going to happen overnight. And today's only Wednesday. And nobody's going to hold over the weekend. Because it's too risky. Yeah, this is bad. Very bad. take a look at what you guys are saying. No, Bitcoin didn't dip because Ross got arrested. Oh man, Bitcoin's really falling right now. I'm gonna get stopped out like any second. I'm probably stopped out right now. Bitcoin's right above 3,700. I'll get stopped out in a second when it drops to like 3690. Well, it depends what chart you're looking at. I'm looking at the Bitstamp chart. That's usually what I'm looking at when I look at Bitcoin. Who cares about Bitcoin? The economy's imploding. There's like real jobs involved here, guys. Like, all right, well, there's some buying stepping in right now, right before the close. That's good. Plunge protection team. So, I'm going to look at the yield curve in a second. Gold just caught a bid as well. This is the gold futures. Spot price. Well, it's the futures, not spot. It's catching a bid right here. There's a lot of buying around 1245, 1250 in this area for gold. This is a 10-minute chart. But it definitely fell with the market. Let's take a look at the yield curve. Give me a second. Let me bring it up. All right, let's see if the yield curve is like inverted right now. It was flat for the past few weeks and months. It's been flattening out. All right, let's take a look. Oh man, look at that. So the short-term interest rates, like anything below like 3 years, or no, well, 2 years, that's pegged at the current rate. And we just had a 25 basis point rate hike. So it's pegged around like 250 or something, or 2.75. But check this out. Like anything above the 2 year, from the 5 year, it's starting to creep up right here. And then the long-term debt, the 30 year, the 20 year, is it's going to rise. But once the short term starts really rising a little bit higher, or even once it's flat, and it's pretty close to being flat, it pretty much is an inverted yield curve. It just doesn't get inverted because the Fed has artificially pegged it down to wherever the interest rates are now, the short-term rates. It's just like, I forgot already. It's like 2.75, 2.5. So it's just, overall, anyone who's buying this dip is pretty crazy. Some buying came in around 3,700 on Bitcoin. Let's hope that holds, because I want this rally to go up to 6,000 to put in that V bottom reversal on Bitcoin. Well, some buying stepped in. but the market's going to close in 30 minutes. And overnight, it's going to be interesting to see what the international market does. Overnight trading. So the next 2 days is going to be interesting. We might get a. I mean, this is so far. This is just a dead cat bounce on the S&P, on equities essentially. But I don't see how people are going to hold stocks over the weekend, because you could wake up Monday to the market just Black Monday, full blown, like another 20% down. And at that point, I mean, hedge funds are already blowing up. So this is just really bad. I don't know what Trump could say, or even the Fed at this point, to make this stop. Because if the Fed, okay, they just increased interest rates as expected. But if they come out and say something like, all right, we're not going to raise interest rates anymore, and we might cut rates if we have to, that's an admission that the economy is so weak that it can't even handle interest rates below like 3% for the short term, which is an admittance that the economy is weak. And this for the past 2 years, all everyone's been saying is the economy is flourishing and blah blah blah, and it hasn't. It was just malinvestment. It was just people confidence, but the economy really hasn't been growing. And yeah, the Fed comes out with these stupid GDP numbers, which are highly inflated. They're not even adjusted for inflation anymore, and it's a bunch of if you go to shadowstats.com, you get the real the real way they used to measure the economic growth and the stats like 30 years ago, but they've been changing it and altering it so it shows the economy better than it's really doing. And I think most people know that. Well, at least I hope so. I mean, you have to be completely retarded to believe what they say. I don't know, guys. I don't know if money is going to go into crypto if the markets are crashing. It might not go into crypto like the first few years, but if inflation really pops up, then I think people will go into crypto because of capital flight. And if crypto's going up while their fiat dollars and their paychecks are losing value, then yeah, you could see capital go into cryptos out of pure desperation. It's just that a lot of people are going to lose their jobs. This time around, it's not going to be like 2018. It's going to be like you lose your job and all your neighbors. Yeah, well, like within like a year or something. And it's going to be bad. I don't want to scare people. It's just prepare for the worst. That's all I have to say. I'm just surprised that he wasn't more dovish. So the chairman, he was pretty dovish, but he was still talking. But this is what he pretty much said. Well, you know, we're keeping our eyes on the economy. If we have to, we'll stop raising interest rates. And we'll do whatever. We'll just keep watching. We'll do whatever we have to. So they were really dovish, meaning they will print more money. They're pretty much hinting towards they're gonna not have any more rate hikes if the markets keep falling. And I guarantee you this was the last rate hike we're gonna see in a very long time, if not ever. And yeah, so I will go more into detail about the economy and the global economy and how the Fed has $66 billion in paper losses. They're pretty much insolvent. So, but I don't want to make this video like 5 hours long. Listen, I do know as the stock market crashes, I'm pretty bullish on gold and silver, so I'm just hoping that this crash takes a few years to play out. It doesn't happen instantly. Like within 6 months from now, it's like the Dow, like the equities are like back to like 2009 levels or lower or something crazy like that. Because if something like that happens, I mean, very quickly, very, very quickly, everyone's life's going to change. Like, and if the Fed's going to come out and they're going to print money, and you're going to see the value of the dollar, like, seriously collapse. Not only are you going to lose your job, but everything's going to be like 3 times more expensive than it is now. I mean, you're not going to be able to live. So, I mean, it's a very big possibility. I mean, this has happened. This has played out so many times in past history. The reason I'm so worried is the industrial jobs in the U.S. are gone, most of them. And if they weren't gone, it wouldn't be such a big deal. But office jobs aren't productive jobs. Shuffling papers and playing on computers like I'm doing here and speculating on financial markets, these aren't real jobs. They're not really producing anything. Like, the U.S. needs to start making shit again, and we don't have factory jobs. We don't have people with skills to even to make things anymore. That's the scary part about it. That's why this is going to be extremely painful. Besides all the unfunded liabilities, like everyone who has a pension and who's expecting money in retirement, it's going to be devastating, and they're too old to keep working. You know, it's going to be bad. It's going to be this is what you get when you want free shit. There's no such thing as a free lunch. And I seriously think the baby boomers thought, well, we're going to get pensions and padded this and that. The U.S. will survive long enough. I won't live long enough to see the U.S. economy implode. So yeah, let's get all this free shit. Let's get Medicare, Obamacare. Let's get pensions. Let's get welfare. Let's do it all. And no, the universe does not. You know, they're gonna get what they deserve. Selling out their children's future, they're gonna get what they deserve. I have no remorse. I mean, in a way, everyone's going to get what they deserve. And, you know, if you don't educate yourself, you're going to get what you deserve. Man, are people going to be hysterical. People are soft these days. They're not strong like they used to be. They're used to fast food and watching TV and getting everything free. Well, I mean, getting everything easy. Things like heating your home and electric bills, things like that are going to be expensive again. People have taken too much for granted. I'm not going to lie. Like, you ever notice in culture how everyone complains about everything? That's decadence. That's peak empire. Everyone's a snowflake. Safe spaces. You know, there's not going to be any more safe spaces. It's just going to be the strong and the smart are going to survive, and the weak are going to perish. Yeah, I watched that Four Horsemen movie. That was really good. Really good. It has to do with financial markets and all that. The documentary, Four Horsemen, that was really good. Every once in a while, I'll go back to these documentaries and watch them again. There's a few good ones. I'll post them in the chat rooms, the ones I really thought that were good. Wasn't like propaganda. It was non-biased, like... Yeah, David Morgan's a smart guy. By the way, he made a crypto. It's in the private membership. It has to do with metals. I think it's going to be a good buy. Just gave away a freebie. What's my thoughts on agenda? I don't want to say it because the algos, you know. Yeah, I believe it. I mean, it's pretty obvious, you know. If you watch the economic forums, Davos and all that, they talk about all that. And depopulation and all that. Which, you know what? I mean, if the elites are onto something with that. I mean, there's just too many people and dumb people. Like, you need there is a limited amount of resources, and although we can have technology and we could replenish all our resources, like loggers. You know, in California, you know why there was huge California fires? Because loggers weren't allowed to log. If they could log and thin out the forest, then it won't burn all down because it's over, you know, it's over densely, the forest gets becomes over dense, and there's too much dead tree branches and leaves on the forest floor from all the overgrowth, and then it burns down. But you know what loggers do? They go in there, they log, they thin it out. They don't just chop it all down like they used to. And then they leave trees and plant new ones so they could log it again 10 years later. Check it out. Look, there's a bid coming in on the Dow. So we have 20 more minutes left till the close. So some buying is coming in. Yeah, I've seen all the speeches, the Bush speeches on NWO. He said it like 1,000 times during his presidency. Oh, Corey James, you're a part-time forester? That's cool. Please stay live 20 more minutes. Yeah. I'm gonna keep my short on. I by the end of this week, I think the market's gonna be lower. I mean, this is really bad. Technically. Just looking at it as a technical analysis who looks at charts, it is screwed. The price needs to get back. Okay, so on the Dow Jones, this is a 10-minute chart, by the way. Let me zoom out. The price needs to get back above 24,800 for any chance of a rebound or a reversal, and to make this a giant bear trap. I don't think this is a big bear trap. What's going to happen is maybe tomorrow the market will trade higher up into this support area, which will turn into resistance now, and then it'll become a giant bull trap. So it could do this, right, in the next 2 days, and then Friday afternoon it's just going to sell off because no one's going to risk holding over the weekend, and this will turn into a giant bull trap, and then down we go, back down. You know what, Trump? I mean, you could already see that Trump's going to blame it on the Fed, which is fine. Trump shouldn't have taken credit for the economy, but at the same time, it's a confidence game. So, you know what a confidence game is? Bernie Madoff, right? One of the biggest Ponzi schemes. The biggest Ponzi scheme ever now was BitConnect. But, a con man, right? What does he do? He gets people's confidence. So when you create a Ponzi scheme, you have to keep the confidence going, and that's what it's been, a confidence game this entire time, and Trump had to play it. I mean, what's he gonna do? Come out and say, yeah, the economy's in a great big bubble and it's gonna crash? Then guess what's gonna happen? Exactly that. So, but he already planned ahead, because he's already blaming the Fed for raising interest rates too much and too fast, and apparently they did. Who knew that just raising it like 2.5% would the real economy can't handle an 2.5% interest rate increase on all debts. This is why you can't borrow your way into prosperity. You can't take on debt and turn that into economic wealth. Because, like, something crazy, like, every, like, let's say every $4 the Fed prints, you only get, like, $1 worth of economic growth. So technically you're creating more debt than economic growth. And then eventually the debt suffocates and destroys economic growth and productivity, because once you can't service the debt, then you can't build new businesses and you can't expand current businesses. Does that make sense? That's why it's a Ponzi scheme. Corey, you build planes and you're a forester? That is really cool. Do you fly planes too? Since I was a kid, I always wanted to be like a jet pilot. Alright, well, I don't see any more questions. There's only 15 minutes left. I don't think I have to stay live, because it's not like it's gonna just shoot straight back up. And I mean, it could, but I mean, it's a little late now. There's only 15 minutes left. So I'm going to take away this little drawing so I don't give people the wrong idea. Do you guys have any more questions or comments? With stocks down, are cryptos in a bull trap? It's very possible. I really hope cryptos don't fall because of the stock market. I mean, this past week, right? The first Monday and Tuesday, stocks were crashing and cryptos started rallying. I don't think cryptos care. like people in crypto, like, just ignore the stock market like it doesn't matter. I am worried about the fact if the stock market crashes and people lose their jobs, are they going to really risk buying cryptos? Are they going to take what's left of their savings, which isn't much? And I'm going to cover that in a separate video, maybe tonight, probably tomorrow. I'm a little tired. I've been up like for a while. And here's gold. And you know, the savings rate out there is terrible. Most people like have no retirement. And are they going to take the little money they have left and buy cryptos if they lose their jobs, or if there's high inflation? And it's going to be interesting. The dollar is not even rallying, which is interesting. It's not doing anything. I mean, Bitcoin, as long as it's above 3,700, it still looks very positive. It could still go and revisit 3,600, retest it, and then go higher. But my stop is around like right below 3,700, so I'm gonna take profits and pretty decent profits on Bitcoin and those altcoins I bought for the private members. And then I'll see where how far it pulls back, and then I will decide in the coming days if I'm gonna buy that dip. That's how I do it. Do I think we're following the 2014 bear market? I mean, it's very similar to it. I've shown the comparisons numerous times for Bitcoin. All right, guys. Well, the market's about to close. The closing bell is about to happen in 10 minutes. And I am tired, and I haven't eaten today. Listen, I'm still bullish for cryptos because the longs have fallen, but the price hasn't fallen too much. And which I made a great call in the newsroom because I said the 3-hourly and what was it, the 12-hourly were on the 9 sell. I warned you guys there is a sell signal on the 3-hour time frame. I put this out at 8:47 a.m. and if you actually took profits then on that 9 sell signal, which I actually did, I took a little bit of profits, like 20% of my trading capital that I put on, and I put stops for the rest. That would have been great. You would have locked in like pretty much 90% of the move because we bought down here. I mean, I literally bought down here. My last few videos were very bullish. I mean, I was literally saying further, maybe 2,800. But I'm already starting to accumulate and I'm buying in. Now, is it confirmed that it's the bottom? No. We need to see Bitcoin go to like 6,000, a little bit higher for it to be a V-bottom reversal. And even then, it's going to pull back. But that would be very positive looking into 2019 and 2020. By the way, if you haven't joined, there's the MMG free room. Telegram group. If you go into the free Telegram group, the links are below my videos on YouTube. And it's pinned in the free room of Wolfpack Cryptos. By the way, have you guys been following the Lightning Network? It's like working and it's being developed and nobody seems to talk about it or care. with the markets tanking, where can regular people take refuge? Are you like financially or like literally like physically? I don't know about regular people. But if you're a multi-millionaire, I would be looking into a private island and have like a bunch of stashed everything I need to survive. Why not? And I'd get a nice satellite dish and just watch the world fall into chaos. Can we talk about proof of keys? Yeah, I just don't want to talk about it now. Cryptos have a higher chance of gains than precious metals. I don't think so. I really don't. And I can talk about that later, but as the Bitcoin price keeps going higher, you're going to see smaller percentage gains. And metals, I mean, according to all the debt in the world, I really wouldn't be surprised if 1 ounce of gold goes to like 8, 7, 6, maybe even $10,000 an ounce. And if gold goes to like anywhere above like $5,000 an ounce, the gold mining stocks, you're going to see like seriously like thousands of % returns. But yeah, I mean, some of these okay, so if you get lucky and you buy the altcoin that survives, yes, you could see massive gains just like in 2017 in the next bull market in cryptos. Just do both. I mean, diversify. Yeah, I don't think you can put links in my comment section. YouTube doesn't allow that. This stream is almost an hour and 40 minutes long. Alright guys, well the market's closing in 6 minutes. I don't see anything happening, which is also really bad that there isn't like even a decent dead cat bounce or some sort of like rebound reversal. This looks very bad. It's scary. I mean, I'm not scared. I'm just saying, like, the market's really tanked on a Fed decision, which was expected. 70%, the market was pricing in, well, was predicting a 70% chance that they were going to raise another 25 basis points. And the Fed chairman literally said, well, we were planning on having 4 to 5 rate hikes in 2019, but we're only going to have 2 now. And it wasn't enough. It wasn't enough, and the market still fell. So, really, really bearish. I mean, this is 20% correction from the all-time high, which is practically a recession. It's pretty much... Once you hit 20%, it's like known by the markets to be considered recession. So it all depends how this week ends, and I just don't know who's gonna hold over the weekend, and I think it's gonna sell off again Friday. Tomorrow we might get a rebound. I don't know. We'll see. All right, guys. I will upload more videos probably tomorrow. Alright guys, I hope you guys enjoyed this. Thumbs up, share it, and leave your comments in the comment section. I'll answer a little bit later. Your questions that you might think of later on. And yeah guys, let's hope that the market somewhat recovers here so we have more time. Alright guys, until next time.